Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Basic Techniques for Financial Analysis. Basic techniques for financial analysis are foundational to making informed decisions in corporate finance. These techniques provide the tools necessary to evaluate a company's financial health, assess its performance, and identify areas for value enhancement. The primary techniques include ratio analysis, trend analysis, comparative financial statements, common-size financial statements, and cash flow analysis. Each of these techniques offers unique insights into different aspects of a company's financial status. Ratio analysis is one of the most widely used techniques in financial analysis. It involves calculating financial ratios from the data provided in a company's financial statements. Ratios can be categorized into several types: liquidity ratios, profitability ratios, leverage ratios, and efficiency ratios. Liquidity ratios, such as the current ratio and the quick ratio, measure a company's ability to meet its short-term obligations. For example, a current ratio of 2:1 indicates that the company has twice as many current assets as current liabilities, suggesting a sound liquidity position. Profitability ratios, including the net profit margin and return on equity, assess a company's ability to generate profit relative to its revenue, equity, or assets. Leverage ratios, such as the debt-to-equity ratio, evaluate the extent of a company's financial leverage, indicating the proportion of debt used in the company's capital structure. Efficiency ratios, including the inventory turnover ratio and accounts receivable turnover ratio, measure how effectively a company utilizes its assets. Trend analysis involves examining a company's financial statements over multiple periods to identify patterns and trends. This technique helps in assessing the company's performance over time and predicting future financial outcomes. For instance, if a company's revenue has been increasing consistently by 5% annually, this positive trend could indicate strong market demand and effective sales strategies. Conversely, a declining trend in net income might signal potential issues with cost management or market competition. Trend analysis provides a dynamic view of a company's financial health, allowing analysts to make more informed predictions about its future performance. Comparative financial statements involve comparing financial statements of different periods, typically the current year and the previous year, to evaluate changes in financial performance. This technique helps identify significant changes in financial metrics, such as revenue, expenses, and net income. For example, if a company's revenue increased by 10% from the previous year, while its net income only grew by 2%, this discrepancy might prompt further investigation into the company's cost structure or pricing strategies. Comparative analysis provides a clear picture of how a company's financial performance evolves over time, highlighting areas that require attention or improvement. Common-size financial statements convert financial statement items into percentages of a common base, such as total assets or total revenue. This technique allows for easier comparison across companies of different sizes and industries. For instance, in a common-size income statement, each line item is expressed as a percentage of total revenue. This approach helps analysts identify how much of each dollar of revenue is consumed by various expenses and how much remains as profit. By comparing common-size statements of different companies, analysts can benchmark a company's performance against industry standards or competitors. Common-size analysis facilitates a more intuitive understanding of a company's financial structure and operational efficiency. Cash flow analysis focuses on a company's cash inflows and outflows, providing insights into its liquidity and financial flexibility. The cash flow statement is divided into 3 sections: operating activities, investing activities, and financing activities. Cash flow from operating activities indicates the cash generated or used in the company's core business operations. Positive cash flow from operations suggests that the company can generate sufficient cash to sustain its operations, while negative cash flow might indicate potential liquidity issues. Cash flow from investing activities reflects cash used for investments in assets, mergers, or acquisitions. Cash flow from financing activities shows cash flows related to borrowing, repaying debt, or issuing equity. Analyzing these sections helps assess the company's ability to generate cash, fund growth, and meet its financial obligations. Cash flow analysis is crucial for understanding a company's short-term viability and long-term financial strategy. The integration of these basic techniques provides a comprehensive framework for financial analysis. Each technique offers unique insights, and when used together, they present a holistic view of a company's financial health. For instance, while ratio analysis might highlight strong profitability, trend analysis could reveal a declining revenue trend that warrants further investigation. Comparative financial statements might show significant year-over-year changes, prompting deeper analysis through common-size statements to understand the underlying causes. Meanwhile, cash flow analysis ensures that the company's profitability is supported by strong cash generation, highlighting any potential liquidity issues that might not be evident from the income statement alone. Financial analysis is not just about numbers, it's about interpreting these numbers to make informed decisions. For example, if a company's return on equity is higher than the industry average, it might initially seem positive. However, if further analysis reveals that the high ROE is primarily due to excessive leverage, the company might be exposed to higher financial risk. Similarly, a company with a strong current ratio might appear liquid, but if its accounts receivable turnover is low, it could indicate potential issues with cash flow management. Therefore, a comprehensive financial analysis requires a nuanced understanding of how different financial metrics interact and impact each other. In practice, financial analysts use these techniques to provide actionable insights for decision-making. For instance, during mergers and acquisitions, financial analysis helps determine the fair value of a target company, assessing its financial health, growth potential, and synergies with the acquiring company. In corporate finance, financial analysis aids in capital budgeting decisions, evaluating the financial viability of potential projects or investments. For investors, financial analysis helps in stock valuation, identifying undervalued or overvalued stocks based on a company's financial performance and market conditions. Thus, mastering these basic techniques is essential for anyone involved in financial decision-making. In conclusion, basic techniques for financial analysis are indispensable tools for evaluating a company's financial health and making informed decisions. Ratio analysis, trend analysis, comparative financial statements, common-size financial statements, and cash flow analysis each offer unique insights into different aspects of a company's financial status. By integrating these techniques, analysts can develop a comprehensive understanding of a company's performance, identify areas for improvement, and make strategic decisions to enhance value. These techniques are not just theoretical concepts, but practical tools that drive real-world financial decision-making, underscoring their importance in the field of corporate finance. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.